Hello and welcome back to Money Never Sleeps. My name is Bob Cruces from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. Today we're talking about something that's on the minds of a lot of people right now, and that's what next year in the markets could look like, and what that means if you're either preparing for retirement or already relying on your portfolio for income. After years with positive returns, it's natural to start wondering whether the environment ahead will feel familiar or very different. If you've been thinking, I'm grateful for the gains, but I'm not sure how much of this I should expect going forward, then this conversation is designed with you in mind. To help frame the discussion, the data and information we'll be referencing throughout the show today is from a recent article from US News and World Report titled, "What Do the Markets Have in Store for Retirees in 2026?" If you're saving for retirement or you're already retired and drawing income from an investment portfolio, the past few years have probably felt pretty good. By most measures, investors have experienced a strong run, especially when you step back and look at the broader historical context. Markets don't always deliver results like this, which is why it's worth spending some time talking about what we've seen recently and what it could mean looking ahead. Take the S&P 500, for example. In 2025, the index returned about 16%. When you look at the past 3 years together, the annualized return has been around 22%. Those are levels of performance that sit well above long-term averages going back many decades. Whenever markets deliver returns like that, it naturally raises an important question: what comes next? As we turn the page to 2026, that question is top of mind for many investors, particularly retirees and those approaching retirement. I've spent time reviewing forecasts from a wide range of financial services firms, and while they may not make for especially entertaining reading, the overall message is fairly consistent. Many forecasts call for another positive year in the markets, but one that looks more modest than what we've grown accustomed to recently. In other words, continued growth is possible, but expectations are generally lower, and volatility is expected to play a bigger role. We've already seen examples of that volatility. Earlier this year, markets dipped sharply in April following the announcement of a new import tariff regime. Those kinds of pullbacks can feel uncomfortable in the moment, especially for investors who are relying on their portfolios for income. But in this case, the market recovered and went on to finish 2025 on a strong note. It's a useful reminder that short-term market movements, while unsettling, don't always change the long-term outcome. Staying disciplined during periods of uncertainty has historically mattered far more than reacting to headlines. From a historical perspective, the last few years have been unusual. Anthony Saglan-Bain, chief market strategist at Ameriprise, recently noted that 2025's market strength pushed the S&P 500 toward one of its best rolling 3-year runs on record. He also pointed out that if the market were to deliver a fourth consecutive year of strong gains in 2026, particularly double-digit returns, it would be something we haven't seen since the late 1990s dot-com era. That doesn't mean it can't happen, but it does highlight just how rare that kind of streak has been historically. That historical context is important because it helps frame why forecasts begin to diverge when it comes to what might drive returns going forward. One of the biggest areas of debate right now centers on artificial intelligence. Over the past few years, AI-related spending has played a major role in lifting large technology companies, contributing an outsized share of the market's overall return. Some analysts believe that leadership may begin to broaden in 2026, with AI contributing less directly to market returns than it has in recent years. That's one reason you're seeing more interest in value-oriented stocks and non-US investments in certain forecasts. At the same time, AI hasn't fallen out of favor entirely. iShares, the exchange-traded fund arm of BlackRock, remains constructive on artificial intelligence while also seeing opportunities for other sectors to perform well. The scale of investment alone is difficult to ignore. More than $500 billion was spent on data centers in 2025, and estimates suggest total AI-related infrastructure spending could reach between $5 trillion and $8 trillion by 2030. That level of capital investment supports not only corporate profit expectations, but broader economic growth as well. Even if AI's impact becomes more evenly distributed across industries, it remains an important factor in many long-term forecasts. Another key influence on markets, as always, is monetary policy. Investors have long paid close attention to the Federal Reserve because interest rate decisions affect borrowing costs, economic growth, and asset prices. When interest rates are rising, often in response to inflation, stocks can face pressure. When rates are being cut, as they are now, it tends to create an environment where stocks have historically performed better. That's where the familiar phrase, "don't fight the Fed," comes from. There is, however, some added uncertainty surrounding the Fed at the moment. Jerome Powell's term as chair is set to end in May, and recent monetary policy votes have shown some disagreement among policymakers about the future path of interest rates. Despite that internal debate, markets currently expect 2 additional rate cuts, which, at least historically, would be viewed as supportive for equities. From a broader perspective, Jurrien Timmer, Director of Global Macro at Fidelity Investments, has described 2025 as an unusual year marked by competing forces. On one hand, there were headwinds such as tariffs. On the other, there were tailwinds from supportive monetary policy. Yet despite those cross-currents, several factors help support market performance. One has been a capital expenditure, or CapEx, boom, where companies are investing heavily in equipment, technology, and infrastructure to support future growth. Another has been the bond market. When risks are rising, bonds often become more volatile or send warning signals. So far, they've remained relatively calm, which many view as a sign of underlying market resilience. So what does all of this mean for retirees? For many people in retirement, investing priorities naturally shift over time. There's often a greater emphasis on preserving capital, generating income, and maintaining liquidity. That frequently leads to increased allocations to fixed income investments like bonds, along with maintaining cash reserves for emergencies and planned withdrawals. The familiar 60-40 split between stocks and bonds remains a common reference point for many retirees, though actual allocations vary widely based on individual circumstances. Income needs and overall asset levels play a significant role in determining how much risk is appropriate. But even in retirement, it's generally unwise to eliminate stocks altogether. History shows that equities have tended to outpace other asset classes over long periods of time, which can help portfolios keep up with inflation and maintain purchasing power. Bonds, meanwhile, are attracting renewed attention. Vanguard has expressed optimism about high-quality bonds in the current environment. The firm maintains a long-term view that both taxable and tax-exempt bonds may offer compelling real returns given higher neutral interest rates. Vanguard forecasts that high-quality U.S. bonds could return around 4% annually over the coming decade, which they believe would provide a comfortable margin above expected inflation. For retirees who value stability and predictable income, that outlook is meaningful. All of this brings us back to a central theme: balance. After several years of strong stock market performance, many portfolios may no longer look the way they did just a few years ago. Rebalancing or bringing allocations back in line with original targets can be an important step, especially as personal needs change over time. As people age, it becomes increasingly important to reassess risk tolerance, income requirements, and the role each asset class plays within the overall strategy. I like to think of investing this way. The goal isn't to chase the money you want, it's to thoughtfully position yourself to have the money you need. And that's the lens we'll continue to use as we move forward. If you have any questions about your retirement magic number, your retirement strategy, or any other parts of your financial strategy, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure: all matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.